Governor of the Reserve Bank of India underlined what we have known and suspected for a while now, that India's slowing economy is a matter of concern. Not only did Shaktikanta Das say this, but also demonstrated it with a third consecutive rate cut, this time of 25 basis points. The decision was a unanimous one from the Monetary Policy Committee, which is also a rarity in itself. And the policy stance was changed to accommodative. But is the 25 basis point rate cut going to be enough? What about concerns like whether banks will actually pass the cuts on, or transmission as it's called? To speak on all of this and more, I am joined now by N.R. Bhanumurthy, Professor at the NIPFP, Dr. S.K. Ghosh, Group Chief Economic Advisor at the State Bank of India, and Anant Narayan, Professor at SP Jain Institute of Management and Research. Welcome to all of you, and thank you for joining us on the show this evening. Mr. Ghosh, let me begin by asking you about the key highlight of this policy. And I know it's been discussed through the day from the very minute details, but what it says about the state of the economy. So far, it has been something which analysts have been saying based on the GDP numbers, but that's only one quarter. Consumer demand, but is it really dropping? The Reserve Bank of India governor today has left nobody in doubt.
No, I agree with you, Tamanna. I think the numbers which has been put out today at terms of the GDP forecast, I think you can clearly see that there is a downside. In fact, a 7% growth estimates with the GDP has, with the RBI has put out for the current fiscal seems to be a little bit on the oversight, on overestimate. Now, having said that, I think the rate cut was anticipated by the market, but the market was possibly expecting a larger rate cut, but the RBI has tried to trade the middle ground, because it has now kept the door open for more rate cuts in the forthcoming policies. I think currently the growth conditions seems to be possibly the global growth conditions seems to be deteriorating very fast. Every day there is a news. So, from that point of view, that will act as a drag on the domestic growth. India's consumer demand has also slowed down, investment demand has slowed down. A part of that could be because of the election uncertainties, but the decline in consumer demand, if we have time, we can discuss that, is possibly related to the NBFC sector disruptions. So, we are actually in for some tough times, and it was clearly demonstrated by the governor when he said that he is going to do anything to stem any possibility of any rout in the system. So, overall, the measures were expected, but the statements which has been made out by, which has been put out by the RBI clearly shows that growth is now of utmost consideration and inflation is actually largely under control.
So it's a huge, it's a shift over time from the focus of inflation targeting to stimulus of growth. In that case, Anant Narayan, is this 25 basis points cut really enough for right now? Could the Reserve Bank have been a little more aggressive at this point, or do you think that the signaling was enough?
Well, Tamanna, to be fair, inflation is well under control, as Shomo just mentioned. You know, the last print was 2.92%. In fact, their estimate for the second half of this current fiscal year is 3.4 to 3.7%, well below the 4% watermark that the MPC looks at. So in that sense, they have not really abandoned the inflation targeting regime. What governor has been saying all this while is that because inflation is under control, they can then look at the secondary aim of making sure that growth is given an impetus. Look, what you said is right. I think the economy is in at least in parts in trouble. We've seen a slowdown in FMCG. We've seen certain sectors which are under stress, including power, airline and shipping, real estate, construction, you name it. And of course, we've also seen NBFCs and the entire financial services ecosystem looking a little soft. To that extent, to your question about could they have done more? Look, in the past, the problem has been that we have done rate cuts. In fact, we've already done 50 basis points before today, but the transmission has always been a problem. I think one seminal change which has come about in this policy is the fact that the governor has constituted this internal committee to look at the liquidity in the banking liquidity in the system. Already the system liquidity has turned surplus since the beginning of June. And I'm guessing here, but I'm guessing that the internal committee will suggest that liquidity can remain in surplus as long as the stance is accommodative. That's very, very good news for transmission. The moment banks are sitting on surplus liquidity, which they have to dump with the RBI on a daily basis, their impetus to buy bonds, to give out loans, to bring down lending rates will be very, very high. And I suspect you will see transmission improving dramatically. To that extent, I think a 25 basis point rate cut is enough with the accommodative stance and with the talk about liquidity. The last bit, the point that he made, the mini Draghi statement that he'll do whatever it takes to ensure that financial stability is met in the wake of the NBFC so-called crisis, that's also extremely reassuring from this policy.
Okay, we're definitely going to come to the NBFC crisis in just a short while. On a day when the whole DHFL story is unraveling, we must talk about it. But I just want to focus a bit on this transmission question, because in his statement, Professor Bhanumurthy, the governor says that transmission is improving. He hints at it improving, though all anecdotal evidence points to not enough of a transmission. That means the cuts are being pushed there, but the banks aren't passing them through. And you're seeing that in sort of diminished appetite for loans, etc. How deep is that issue?
Well, I think it's not a really rocket science to understand why there is no transmission. And I think this is what we have been arguing for quite some time, that interest rate cuts need not necessarily lead to investments. Yeah. Given the kind of situation the banks are right now, and in fact, there are some estimates that say that the NPA crisis is going to worsen further in coming months, and especially when we start looking at the mudra loans and all those things. Given that kind of situation, it is very difficult for the banks to push loans at this stage. I think they need to really adjust their own balance sheets first before they do their business. So I think in that context, it is not really a good way to understand that the banks would pass on the kind of interest rate cuts on the lending rates, but on the deposit rates, I think there seems to be much more faster. So what's happening right now is that
banks are happy to give you less money, but
yes,
they are happy to take more.
And actually, what they are trying to do is they are trying to shift the the whole balance sheet problem on the household savings.
Yeah.
I think that's something is not really. That's one of the reasons why we do see there is a huge dent on the overall domestic demand conditions right now. So I think, in fact, I'm not really a great fan of interest rate cuts to really push investments. I'm one of the guys who believe that it is the savings-led investment growth that actually leads to revival in the Indian economy. In fact, we have seen that between 2004 and 2008, where it's actually the savings that actually pushed investment. It was not really the interest rates. Somehow we still stick to this textbook kind of a relationship where the interest rate cuts would lead to investment hike. I think that seems to be, that needs to be really relooked in the current context.
Yeah, that's a very interesting point. I think we should open that up to debate. Mr. Soumyakanti Ghosh, do you agree with that? Transmission is dismal, and unless you incentivize household savings and push them into investment, it's not really going to help with a 25 basis point cut, perhaps.
No, I think let me just, Tamanna, just give you some very basic statistics over here. I think as of now, the problem in the transmission is that if you look into the bank balance sheet, they don't even borrow 2% of the liabilities from the RBI window, and that borrowing from the RBI window is against a collateral of G6. There are some banks which doesn't even borrow from the RBI. They in fact mobilize deposits so as to fund their credit growth, which is in excess of 20-25%. So until and unless we have a system whereby the liquidity which you are taking from the RBI is being used to fund your credit growth, we will have this perennial problem of deposit growth lacking credit growth. For example, last year, I think as of now, for example, if you just ask me the current issue, I think keeping the liquidity in surplus mode will definitely aid transmission, but that will take a longer time. However, the crucial part is that as of now, last year there was a cash leakage from the system of around 3 lakh crores. So that means, and that has impacted the deposits significantly. And most of the banks right now are actually in a significantly competitive environment trying to mobilize the deposits. So if that is the case, a cut in the deposit rates from the current level will be difficult to come by, Of course, it will come over a point of time if the system remains in the surplus mode, but it will be slow and steady, and therefore, the transmission to an apparent lending rate curve will also be slow and steady. So, we have to be patient with the current the current stand of the RBI, but as of now I think, to me, this is the biggest problem, is that banks do not have enough deposits to fund their credit growth. And it's true that at the end of the day, even today, I think if you look at the bank deposits as a part of financial savings, they are still hovering at 40% or even more than that. So, therefore, bank deposits still is an potent tool to mobilize credit growth and also of the financial savings part.
And I think that's a valid point that you made, that are you incentivizing those enough? I also want to come in a bit of more detail to the question of this shadow banking crisis and what the governor has said today, what Anant called a Draghi-like statement. Are we still not understanding the depth of the crisis there, or are we hoping it will blow over quicker? Could more have been said in the policy today on that, Anant?
Great question, Tamanna. One very quick point on this investment point which was made earlier.
Yeah.
Look, I completely agree that interest rate cuts are not the solution for stirring investments. The point we are trying to do with lower interest rates is trying to build up some consumption and give some relief to NBFCs. It's not a great objective, but it's being done. And you're absolutely right. We need a lot of other things to happen for investment cycle to come back, starting from solving all the problems we have in the power sector, NBFCs, and so on and so forth. So it's a long-term reform which needs to be done. It's not really interest rate or monetary policy. On the specific question that you asked around NBFCs, look, I think the core issue around NBFCs and housing finance companies is there is a trust deficit around them. For one, there is a problem of asset liability mismatches. They clearly grew their assets long term very quickly during especially after demonetization, and they are funding themselves of cheap money available after demonetization for the short term. So there are asset liability mismatches. More insidious is there are questions about the asset quality of NBFCs and housing finance companies. Not all of them, but some of them. Here is a quick statistic. As per the financial stability report of the RBI, as of September last year, NBFCs had a gross non-performing asset of only 6.1%, whereas banks were at 10.8%. Now remember, banks had gone through a complete asset quality review which forced them to reveal the true state of their assets. NBFCs have not gone through it. So in a sense, that 6.1% number nobody believes in. Given the amount of exposures they have to real estate, to construction, to loans against property, the feeling in the market, rightly or wrongly, is that the numbers ought to be a lot higher. That is the core issue which has to be addressed. Now, that issue cannot be addressed by liquidity and lower interest rates alone. Eventually, you have to undertake hard reform there. You have to go through something like a credible asset quality review to reveal the true status and make sure people agree with that. Second, you have to do some reforms, bring in capital. Third, you have to change the market infrastructure, credit rating agencies, secondary market liquidity, etc. And that's an onerous task which needs to be done. It cannot be done overnight, and certainly not by the MPC. So to your point, should something have been done today? Look, the point is that at the first sign of trouble, if people expect RBI to step in and fund losses for somebody else, that's not a great situation to be in. Yes, RBI should do what it can to ensure that truly solvent and solid NBFCs do not face liquidity issues, and I'm sure they'll take towards that. But if there is a question mark about the asset quality of certain NBFCs, should the taxpayer or the RBI really step in at the first sight of trouble to actually bail them out? And I think it's $1 billion question.
I don't know if
they have to worry about contagion, etc.
Sure,
but I don't think this is the right time.
No, I get your point, Mr. Narayan, but I don't think we're necessarily talking about bailing them out. I think I want to take forward from the point you made and take this to Dr. Ghosh. It's more of a question of who's willing to sort of lift the carpet and check what's underneath it. Like what happened with banks some time ago. Do we really know the depth of the trouble in the shadow banking system?
No, I think, Tamanna, the problem here is that obviously what Anand referred to in terms of an asset quality exercise, but my simple sense is that the system has gone through enough pain in the last 4 years. We had an AQR for the banking sector. Obviously, it resulted in cleaning up of the balance sheet. but I am not sure whether an AQR at this point of time it could add enormous pain to the financial system when the growth is already down. So that is one point. The second point is that I think in NBFC already we are seeing a distinction of identifying their better quality NBFCs and not so better quality NBFCs. So there is already a churn in the market. Point number 3, if you actually look into the data of the NBFC's holding of cash balances, that have increased close to 60% of the last from March 2019 over September 2018. So NBFCs, so that indicates that it's more of a solvency issue, and the policy of the RBI, what it is doing in terms of the strict asset liability monitoring, the new rules which they are bringing in, that is working. Possibly it is not working to the extent which the RBI or we desire to, but my sense is that at the end of the day there will be churn in the financial system. Better quality borrowers will be identified, and not so better quality NBFCs should actually be weeded out of the system. So for that, whether we need to do some sort of an identification of the issues involved, that's a debate which actually we can do. But my sense is that with currently the system in a lot of pain in terms of the growth outlook, domestic growth outlook, consumption outlook, investment outlook, I think as of now some sort of this message could work on the opposite manner also.
Mr. Bhanumurthy, would you like to comment on the whole question of NBFCs and what was expected from the RBI? Of course, one view coming in on the panel that what they've done so far is enough. You can't really expect them to go with a sledgehammer at this right now.
Well, I think I am not from the industry the way the other participants are, but the fact of the matter is even the RBI does not know what is the depth of this crisis in the NBFC sector. So, I think until unless we do not have that information, my guess is that it is not going to stop at ILFS alone, and we have seen DHFL is coming out. So, we do not know up to where it is going. I think that clarity is something which is missing in the market.
Would you want to know right away and then deal with the problem no matter how enormous it is, or take your time like what the point Dr. Ghosh was just making? Maybe it's not the right time to lift the lid.
No, I don't think we need to prolong this. I think we have done this same kind of strategy for the past 5 years on the public sector banks. So we have been talking about this NPS since 2013 and 14. So we've been dragging this, and that's one of the reasons there is a huge drag on the Indian economy as well.
Yeah, you're provisioning, you're recapitalizing.
So, I mean, every day you come out with the new issues in this whole sector. So on the NBFCs, as I said, my understanding is very limited, but my guess is that it needs to be sorted out as soon as possible if you really want to revive the whole financial sector. So I think that's very, very important.
Absolutely. I want to just change tack to some of, one of the key decisions and a couple of key decisions from today's announcement by the Reserve Bank on the retail side, and one is doing away with fees for RTGS and NEFT kind of transactions, and I just wanted to highlight and bring my speakers on into the point of how crucial that is at this point. And let me start with Soumyakanti Ghosh over here, and just to comment on why this is very key at this stage of a push for digital payments.
I think Tamanna, I think some of the steps on the development front are actually very welcome. For example, the leverage ratio, what the RBI has done is adjusted the leverage ratio, and that will actually going to increase the lendable resources of the banks by at least around 1 lakh crore. So that's a very big number. Also the ATM fees, which we have said is actually a very the waiving of the ATM fees and the
it's still a committee
transactions,
right now.
the electronic transaction, this is going to boost the digital.
Yes.
But the decision to waive of the charges, that is going to help the digital transaction in a big manner.
No, absolutely. No, the only point I was making is that the digital transaction charges are waived, but on the ATM fees, there's still going to be a committee. Anant Narayan, would you like to comment on how that has become such a crucial part? Because as more and more people have been moving to digital payments, they find that they're in a sense penalized for it vis-a-vis cash. And for the whole government, I'm not talking about the RBI here, the push towards digital also came with this plan to incentivize digital transactions, which hasn't quite happened yet. Do you think that this is an important step in that context?
I think it's absolutely crucial, Tamanna, and to that extent, I guess Nandan Nilankani's committee has come out with a good report as well. Yeah. Look, we've got to ensure that the objective which was behind demonetization, which was going towards digitization and away from currency, for all the reasons around it, whether it's to curb corruption or whether it's to make the system more efficient and to improve banking liquidity. I think it's absolutely paramount. Nobody can disagree with that. And as things stand right now, as you rightly said, you still find that holding cash might at the margin be cheaper than actually paying the charges that you sometimes have for digital transactions. So to that extent, bringing down the charges on RTGS, NEFT, making that more popular, more usable, plus what Nandan Nilankani suggested, amongst other things, bring in more point of sale equipment so that more plastic can be used, I think is absolutely welcome. Let's not forget, as Shomyo was mentioning earlier, the currency in circulation last fiscal year went up quite sharply. So the one-time impact that we had during demonetization has more or less gone away, and we've gone back into that large increases in currency in circulation. That's not a good sign for us, and anything to curb that will be very, very welcome.
Yeah, it's an important point that Anant makes, because let's not forget demonetization and its whole purpose, one of the many purposes that it claimed to have was to push digital payments, and now here we are back with a buoyancy of cash. One of the reasons is, why will people lose money to transact digitally? Another thing is with ATMs as well. It's become more and more penalizing to withdraw money from ATMs.
Well, I think I think it's very, very important for us to increase the digitization. I think that's what Nandan Nilankani committee has recommended, and as consumers, we also face sometime even transactions in the financial markets, and some of the recommendations that they made today. Finally, I think what is more important is to bring down the transaction cost. So if whatever the policy measure that RBI has come out today, my guess is that it is going to reduce the transaction cost, and I think it will bring in many more transactions into the overall digital market, I think.
Okay, so back to the overall policy we saw and the statements that we saw today. The large consensus, Mr. Bhanumurthy, is that the stage is set for another cut in August. Yes. That the RBI has now started to sort of loosen its fist on rate cuts. Do you agree with that?
Well, they might do it, but my guess is that they should not do it.
Why so?
That's what I said. Until unless we don't clean up the mess.
Yeah. I
mean, you cannot really push the household savings towards financing the balance sheets of the banks. I think that's my take.
Samekati Ghosh, what do you have to say on that? Another rate cut is what everyone's predicting in August, and a very interesting point of view here coming from the panel, saying that you can, but don't do it.
No, I think we can debate about the timings of the rate cut, whether it is in August or in October, but I am sure that there could be a couple of rate cuts more, because the way the global demand has been moving, the domestic consumption demand has been moving. So I think there is scope for further adjustment in the repo rate.
Okay. Anant, do you agree with that?
Well, I have sympathy for Mr. Bhanumurthy's view. Let me just add to that very quickly. Look, I think it's easy to make rate cuts and liquidity the punching bag every time the economy goes through trouble. Yes, you can give relief through rate cuts and liquidity, but let's not forget that real reform is required on multiple levels, and you cannot substitute for that with rate cuts or liquidity. Second thing I want to warn you is that in July we also have the budget.
Yes.
The budget numbers are not looking great. It does look like the borrowing program of the government can be very, very large. And one of the reasons why interest rates have been sticky and up is because the government and the quasi-government borrowing has been extremely large. So a lot depends on how fiscally prudent the new finance minister comes out on the budget.
Absolutely. The direction seems to be set for more rate cuts, but bigger cleanups are required, because just these rate cuts are not going to really boost the economy. The RBI today making it clear that it too shares the concerns of an economy that seems to be slowing down. I want to thank all of you for joining us on the show this evening and watching the India Development Debate. Stay tuned to ET Now.